So, Dave, what are you seeing in the market in terms of how you're seeing investors behave in your part of the world?
Generally, I think they're still pretty positive about investment in companies. I think there's a reset that people are starting to now consider, and I think I'd sort of say people are more cautious, but cautiously proceeding with some sort of excitement. I think in the background there's a sort of bit of Warren Buffett in all of us. It says, in times like this, there's actually quite an interesting investment opportunity. But for us, I suppose, where do we look now? We sort of say, does the investment opportunity still make sense? Has the market changed? And, the big thing now is, if you are looking at investment, is that a sufficient investment for the next 24 months? We probably would have previously sort of said, can the company keep on going for 12 months? We've probably extended that out. And so there's probably a little bit more realism or conservatism in the planning process now. So we're generally still actively looking at investments, but with those sort of caveats now in place. What about yourself? What are you seeing?
So yeah, I've been doing the rounds of all the angel networks in the last week or so, and even just come off the back of a meeting with some of our most active angels at Angel HQ, and one of the guys asked, how many of you are going to stop investing? Put your hand up if you are. And there were 20 plus people on the call, no hands went up. So, and that reflects the conversations I've been having too. People are certainly intending to go on investing, but we know intent and action and reality are two slightly different things. So that said, the rhetoric has been slightly more cautious. So people are there's a really clear theme about, I'm going to be supporting my existing portfolio, a little bit more rigorous about new deals. But like you, very, very clear that this is, this will inevitably throw up a really great vintage of companies that are resilient and agile and supermarket focused. So I think people have kind of got that. It's just the extent to which their head will overrule their heart in reality, and those emotions of scarcity are obviously bubbling away. They go.
Yeah, I think similarly, a couple of comments that we noticed both from GFC days, which we lived through, and actually made some really significant investments, Power by Proxy and Aroa were some of our key investments after GFC in 2009, 2010, and they've gone on to huge successes. What we found was the investors who are really passionate about the space kind of double down and really get into it. People who probably have a wider portfolio, I'd sort of say maybe some family office, maybe some other people who maybe get a bit scared off from the venture capital space because, the risks are there. I think this is a stark realization to them that, this is a risky space. Some corporate venturing kind of gets a little bit deterred. But the hardcore venture investors and angels, I think, really understand this is a great opportunity to, get some great innovation companies, different people thinking about different ways to solve a new set of problems which have emerged and how to progress from there.
Yeah. And I think some of the research too shows that angel investing is less impacted by recessions than the venture kind of side of things. And definitely, angels are motivated by things beyond the financial returns. So all of that stuff around creating jobs, keeping people in good jobs, creating aspiration in your economy, that's, writ large at the moment.
And how do you see from people you're talking to is the impact and what timeframes? People talk about near term, medium term, and long term. What does that mean to you, and how do you think that affects the investment horizon in those near, medium, and long terms?
Yeah, I mean that's a really that's something that's to the fore with most people I'm speaking to, is just revisiting those capital strategies to make sure that they still stack up. And definitely making sure that the runway is at least 12 months and preferably 18 months. That's a very common theme. And a lot of kind of people feeling a bit sort of conflicted by the fact that they don't know what the scenario is going to look like, and yet preparing for the worst, but not sure if the worst is actually going to happen. And that's a difficult place to be in. and a lot of trying to protect jobs and talent. That's a really clear theme as well amongst a lot of the investee companies and the investor directors who are talking to those companies.
How long this is going to last? I mean, a lot of people talk about near term being 1 to 3 months, and medium term 3 to 6, and long term 6+ months. I mean, I get a real view from the global sort of perspective is this isn't going to go away in 6 months. This is a 36-month sort of process. And so for me, near term is probably this adjustment's going to take probably 3 to 6 months. And then we're going to kind of find out exactly how we can grow out of that over the next 6 to 12 months. And then 12 to 36 months is going to be a whole new regime in which we can grow with different solutions and new innovation. Yeah, and there's obviously the big reset in terms of adjusting your expenses to meet what the future may hold in front of it. I mean, from what we're sort of seeing is, I'd sort of say if you're a young company looking for capital over the next 12 months, it should still be pretty good. I'd sort of say that a lot of people still have a lot of dry powder, as we call it in our business, certainly for 2020. From a venture capital point of view, where we have a fund structure, it probably will get a little bit more difficult next year than this year. Key reason for that is funds will start to use up its free cash in terms of investing it on the opportunities through this year. And I think the new funds will be a lot slower in uptake. So with a lower cadence of new funds coming in, there might be a bit of a squeeze into next year. So my advice for companies that are looking for capital now is keep on going strong. Don't take your foot off the metal, and keep on and do everything you can to try and raise the capital this year.
I think that's one of the things, one of the sort of characteristics of New Zealand venture and our founders particularly, that they're very careful with cash and they do a lot with a little. We are very efficient when it comes to that. And same sort of message to founders from us as well. Be really clear about what you're raising, how much you're raising for what, and be really clear about what your value proposition is. We're really being clear with investors to make value-based decisions. And in a New Zealand context, that has some extra layers, which I actually think are going to serve us really well in terms of sustainability and that really powerful value proposition.
Yeah, and you're right. I mean, New Zealanders have always been frugal with its cash, and I think that positions us well for these types of market conditions. The other thing I think also that, if you're a company now and looking at how you prepare yourself going forward for the next 12 and 24 months is, innovation absolutely screams out when market conditions are so volatile. There's just a heap of new opportunities that generally can solve new problems. There's whole areas around, how do we interface and interact and run businesses in a contactless environment. There's going to be a whole bunch of innovation around, with travel restrictions, both nationally and internationally. How do we conduct business going forward from there? These are all great opportunities for innovation. The other thing I find, which I'd encourage young companies and small companies, is they can adapt and change reasonably quickly. Larger companies have a lot more baggage that it doesn't allow them to necessarily transfer to new ways of doing things fast. And if you can innovate and change fast, you can often get the jump on large companies.
Yeah, I was just going to say, and that innovating and changing fast kind of speaks to empathy and being really canny to what the market needs. And I think that sort of that authentic kind of connection that works with markets, and it also works with investors. So just making sure that you really do your research on who you're going to approach for capital and why, and making sure that you do that in a really kind of sincere way. I think that's going to get a lot more traction than in the past, where you could just front with a pretty smooth deck and a pretty smooth pitch and be guaranteed of getting some money. That's less the case these days.
Yeah, and it's about, as you said earlier, it's about consolidating, getting your cash flows sorted out. But never lose sight of the longer term picture of there's also opportunities because, generally we found post GFC, there was a lot less noise in the market. So, if you're doing things like Google ads for your marketing, the spend that you have on Google ads just went right down. There's lots of companies out there who just put a stop on all their spending around marketing. And that just created a whole new opportunity where you could get more bang for your buck around the marketing dollars that you do and are willing to spend. Again, that advantages small companies who want to use their dollars wisely, but still get market share. So, we've also found that with the less noise, greater speed to adapt, you should actually look at this as a really great opportunity to cut through some of the bureaucracy, some of the complacency that you've often had trying to be a struggling startup and growing market share. Really great opportunity now. Just keeping a positive attitude about what you're trying to do and keep focus. This is about laser focus, I think.
Yeah, laser focus and that whole kind of thing around retention of value and retaining. The other thing that's really great in today's market is somebody put it, which was a slightly harsh way to put it, but there's a lot of talent liquidity. So, unfortunately, some businesses with some incredible talent are going to not crack it. So keeping an eye out for those kinds of people who are available to help you, and also being a little bit more creative with your use of employee share ownership plans as a way of attracting that talent and keeping and retaining talent. I think that's another opportunity for companies in today's world. What are you seeing around valuations? Is that something, are you seeing that, investors are really putting the pressure on founders and deals to kind of reset that? And what are the implications of that?
I think what you're starting to see is there's less extremes in valuation now than there were probably 6 months ago. Partly that's because the people who are investing now have always been sort of based their valuations on key metrics, and that's not really changed from the 6 months ago to now. So from a founder or a company perspective, I'd say the valuations have got a little bit more realistic, and mainly because without the strategic investors or the family office coming into the play, then essentially it's probably a same set of valuation going across all sorts of investors. So I think it'll start moving towards a very narrow set of valuations going forward. However, that valuation will start going down. I mean, there's no hiding the fact that revenues have gone down. As revenues go down and growth goes down, multiples go down. So I think companies have to expect that as the multiples go down, then they're going to have some valuation pressure. That's not to say that they won't recover, and it's really a case of getting the recovery in the time frame that hopefully you'll have a bit of a shock to the valuations, but they'll get back up there pretty quick. It all depends on how fast and how quickly you can get back into the market and regain your revenue streams. What about yourself?
Yeah, it's the same kind of thing. And, the valuation discussion's always a fraught one, and, it doesn't stop being a dark art just because we're in a recession. And so the advice that we've been giving is that you just need to be even clearer about what your value proposition is and have a really pithy understanding of your capital strategy and where and who you're going to raise from next at what valuation above and beyond the one that you're pitching for now. And I guess sort of in that kind of context, we've been giving a little bit of advice about terms, and that if you need to kind of make your deal or your opportunity more attractive, be more inclined to give on economic terms in the current climate than control rights, because you are still the person who knows your business best. And so just be wary of that kind of pressure when it comes to doing deals. And just to flip back, I guess, round out on that valuation discussion, we are sort of hearing, things like 25%, 40%, sort of contraction in valuations. I'd be really wary of pressure being brought to bear on you as a founder, with that kind of rhetoric, without people having a really kind of clear and deeper explanation for why they're putting that kind of pressure on you.
Yeah, I mean, at the end of the day, valuations are heavily correlated with growth.
Yeah.
And, if you are retracting in growth, then you have to expect that. I think your point is quite clear. Is sometimes it's about getting enough money and cash into the business that you can then move out of that current growth stagnation point that we're in at the moment, to get to a higher one, and then prove to all the investors that you are worth a higher value. So timing is quite important on this. In some respects, whilst everybody's still consolidating, unless you're in a process of seeking capital, then I think valuations will struggle in this really next couple of months. But if you're starting a capital raise process, you probably will close, in the next 2 or 3 months, and hopefully we should be over, not so much over the worst, but at least understand what the worst looks like. And then I think there'll be less panic valuations going through, if we want to call it that.